Investment. Ladies and gentlemen, let's talk about money moves for 2026, because this year is shaping up to be one of the most defining times for investors who are serious about building wealth. The choices we make now with stocks, real estate, and other investments will set the tone, not just for this year, but for the entire decade ahead. First, let's talk about the stock market. In 2026, the big opportunity isn't in chasing the next hot tech IPO or meme stock. That game might make headlines, but it rarely builds lasting wealth. Instead, the smartest investors are shifting their attention towards stable companies with strong fundamentals, especially those that consistently pay and grow dividends. Think of these as your financial foundation. Investment. While hype-driven stocks can crash overnight, dividend-paying companies reward you simply for holding them, creating a reliable cash flow that compounds over time. In a market full of uncertainty, stability is your greatest advantage. Now let's move to real estate. This asset class continues to prove itself as a powerhouse for wealth creation. Rents are rising, inflation is sticking around longer than expected, investment, and people will always need a place to live. That's why property ownership in 2026 isn't just about building passive income. It's also about protecting your money from inflation. Whether it's single-family rentals, multi-unit properties, or even fractional real estate investing, the opportunities are massive if you take a long-term perspective. But here's the real secret. You don't want to put all your money into just one area. The smartest money move in 2026 is diversification. By balancing your portfolio across stocks, real estate, bonds, and even alternative assets like rise or index funds, you create a safety net that can survive market downturns. When one asset class takes a hit, the others often provide stability. This balance is what allows investors to not just survive volatility, but thrive in it. Finally, let's talk mindset. Too many people lose money because they try to time the market or jump on whatever's trending. Investment, that's not investing, that's gambling. The true wealth builders in 2026 will be the ones who think long-term. They'll buy quality assets and hold them through ups and downs, letting compounding do the heavy lifting. Remember, success in investing isn't about making one lucky trade. It's about making disciplined, consistent decisions over years and decades. So here's the bottom line. In 2026, your smartest money moves are about prioritizing stable dividend, paying stocks, leveraging real estate as both income and inflation protection, diversifying your portfolio across different assets, and keeping your focus on the long game. Do this and you won't just be making money moves. You'll be building a financial future that stands the test of time. When it comes to investing in stocks in 2026, the focus should not be on chasing the next shiny object or whatever's trending online, but rather on building a foundation of stability and predictable growth. Too many people get caught up in hype-driven movements, investment, thinking that they can make quick money by buying into the latest stock that everyone is talking about. The reality is that this approach is far more likely to lead to losses than long-term gains. What smart investors understand is that wealth in the stock market isn't created by taking reckless bets. It's created by carefully choosing companies with proven track records, strong balance sheets, and the ability to consistently reward their shareholders through dividends. A dividend is more than just a payout. It's a company's way of sharing its success with you, the investor, and it often signals that the business is financially healthy and well managed. In 2026, with market uncertainty still a reality, this kind of approach is more important than ever. Economic cycles are unpredictable, interest rates are shifting, and inflation continues to play a role in shaping markets. That means your portfolio has to withstand volatility without leaving you in panic mode every time the market takes a dip. Dividend paying stocks are a powerful tool here because they provide a steady stream of cash flow regardless of what the market is doing on any given day. Even if the stock price fluctuates, the dividend check still shows up, giving you income you can reinvest or use as you see fit. Over time, reinvesting those dividends compounds your returns in a way that chasing speculative stocks never will. Another key reason to focus on dividend growth stocks in 2026 is the protection they offer against inflation. If you're holding on to cash, inflation erodes its value. But when you own shares in a company that not only pays dividends, but also increases them year after year, your income grows with time, keeping up with rising costs of living. Think of it this way. Investment, a solid dividend stock not only gives you ownership in a reliable business, but it also provides a paycheck that gets larger as the company grows. That's a powerful combination for building long-term wealth. This doesn't mean every dividend stock is worth buying. You still need to look at fundamentals. Is the company growing revenue consistently? Does it have a manageable level of debt? Is the payout ratio sustainable? Investment. Or is the company overextending itself just to appear attractive? These are the questions that separate strong long-term investments from potential traps. In 2026, it's not about buying a stock just because it pays a dividend. It's about buying quality businesses that can sustain and grow those payments over decades. The mindset here is simple: prioritize stability, cash flow, and long-term growth. Forget the noise of day traders bragging about their latest win. A portfolio anchored in solid dividend-paying companies is like a tree with deep roots. It might sway in the storm, but it doesn't break. That's the kind of foundation that can carry you through whatever 2026 throws at the market. Real estate in 2026 continues to stand out as one of the most powerful tools for building wealth and protecting your financial future. While the stock market offers liquidity and quick entry and exit, real estate provides something equally valuable: tangible ownership of an asset that not only generates passive income, but also shields you from the ongoing impact of inflation. This is a year where rents are projected to rise steadily, demand for housing remains strong, and inflation keeps the cost of living on an upward curve. That's why owning property is more than just a way to build income. It's a strategic move to preserve the value of your money over time. Every month that a tenant pays rent, you're not just covering expenses, you're creating cash flow that can be reinvested, saved, or used to expand your portfolio. What makes real estate unique in 2026 is the dual role it plays. On one hand, it gives you a consistent stream of passive income through rental payments. On the other, it acts as a hedge against inflation because property values and rents typically rise as the cost of goods and services increases. If inflation makes your groceries and utilities more expensive, it also makes your rental property more valuable. That's a win-win for investors who think long-term. And unlike stocks that can swing wildly based on market sentiment, real estate tends to move in slower, more predictable cycles. This makes it a stabilizing force in a portfolio when everything else feels uncertain. Of course, the real estate game in 2026 has evolved. It's no longer just about buying a home and renting it out. Investors are now exploring multiple strategies: single-family rentals in growing suburban areas, multi-unit properties in urban markets, and even fractional real estate platforms that let you invest without having to manage the property directly. Each of these options gives you access to the benefits of real estate ownership, but with different levels of involvement and risk. The key is choosing the strategy that fits your financial goals, time commitment, and risk tolerance. Another advantage of real estate is leverage. With a relatively small down payment, you can control a much larger asset. This means the returns on your invested capital can be significantly higher compared to other asset classes. For example, if you put 20% down on a property and that property appreciates by just a few percent per year, your actual return on investment is much greater because of the leverage you used. Combine that with rental income and potential tax advantages investment, and you start to see why real estate has created more millionaires than almost any other investment type. The bottom line is simple in 2026. Real estate is not just about owning a piece of land or a building. It's about creating a financial safety net. It's about turning a physical asset into a source of income, appreciation, and protection against rising prices. Whether you're buying your first rental property or adding to an existing portfolio, the opportunities in this market remain strong for those who are willing to think long-term and take action. Diversification has always been the cornerstone of smart investing, and in 2026, it's more important than ever. Markets are unpredictable, interest rates are shifting, and global events can cause sudden swings that no one can fully anticipate. That's why putting all your money into one asset class, whether it's stocks, real estate, or even cash, is simply too risky. A well-diversified portfolio acts like a safety net. It doesn't just help you survive downturns, it positions you to take advantage of growth opportunities across multiple areas. The idea is simple: when one asset struggles, another often performs well, balancing out your overall returns. For many investors, stocks will remain a central part of the portfolio. They provide growth, liquidity, and access to some of the best performing businesses in the world. But stocks alone come with volatility. That's where real estate steps in, offering steady rental income and a hedge against inflation. Owning a property not only builds equity over time, but also provides cash flow that can support you when markets dip. Investment. Adding bonds into the mix can also stabilize returns since they often act as a counterbalance to stocks. When stock markets face turbulence, bond values tend to hold steady or even rise, providing an anchor in uncertain times. Then there are alternative assets, which in 2026 have gained more attention than ever before. These include things like real estate investment trusts, REITs, commodities, and even exposure to emerging asset classes like private equity or fractional investments. Alternatives provide an extra layer of diversification by giving you returns that aren't always tied to traditional stock and bond performance. For example, investment. Gold and commodities can protect your portfolio during inflationary periods, while REITs can give you the benefits of real estate without the need to directly manage properties. Investment. The beauty of diversification is that it smooths out your investing journey. Instead of riding the emotional highs and lows of a single market, you build a portfolio that spreads risk across different sectors. This doesn't mean you'll avoid losses completely. Every investor faces downturns, but it does mean that your portfolio is far less likely to collapse when one asset class hits a rough patch. Imagine holding only tech stocks when the sector crashes. That's devastating. But if you also had real estate producing income, bonds providing stability, and alternative assets balancing out inflation risks, the impact would be much easier to manage. Diversification is also about time horizon and goals. If you need short-term liquidity, you keep some cash and easily accessible investments. If you're investing for retirement decades away, you tilt more toward growth-oriented stocks and real estate. By aligning diversification with your timeline, you not only reduce risk, but also ensure that your money works for you in the most efficient way possible. In 2026, the smartest investors won't gamble everything on one play. They'll build a resilient portfolio, balancing growth with security and understanding that wealth isn't built overnight. It's built by consistently managing risk while allowing compounding to do its work. That's the real power of diversification. The difference between people who build lasting wealth and those who constantly struggle in the market often comes down to one thing: mindset. In 2026, the temptation to chase quick profits will be everywhere. From social media hype about the next big stock to influencers claiming they've cracked the code to instant wealth. Investors will be bombarded with noise that encourages short-term thinking. The truth, however, is that real wealth is rarely built through quick wins. It comes from having the patience and discipline to buy quality investments and hold them for years, even decades, while they grow in value and generate consistent returns. This long-term mindset is what separates successful investors from gamblers. One of the greatest challenges for investors in 2026 is learning to resist the urge to time the market. It's human nature to want to buy when everything looks promising and sell when fear takes over. But countless studies and real-world examples show that timing the market is almost impossible to get right consistently. Miss just a handful of the best performing days in the market, and your returns can be cut in half. That's why the focus should be on time in the market, not timing the market. The longer you hold quality assets, the more compounding works in your favor, turning small gains into life-changing wealth over the years. A long-term approach also helps you weather inevitable downturns. Every market goes through cycles of growth and correction. In the short term, those corrections can feel painful, but they are also opportunities for disciplined investors. Instead of panicking and selling, the long-term thinker sees these dips as buying opportunities, moments when strong companies and solid assets can be purchased at a discount. By keeping a cool head and staying committed to the bigger picture, you not only avoid losses from selling too soon, but also set yourself up for stronger gains when the market recovers. Patience in investing doesn't mean doing nothing, and it means being selective about where you put your money. In 2026, this could mean choosing companies with sustainable business models, real estate in high demand areas, or diversified funds that spread risk across sectors. The important part is that once you've made a smart investment, you give it time to work. And compounding doesn't happen overnight. It happens when dividends are reinvested year after year, when property values appreciate slowly, and when your portfolio grows steadily over decades. The mindset you bring into investing is just as important as the assets you choose. If you're constantly chasing the next hot trend, you'll likely burn out your portfolio and your confidence. But if you develop the patience to let good investments grow, you give yourself the chance to create not just short-term profits, but long-term financial freedom. In 2026, The investors who win won't be those who made a quick score. They'll be the ones who played the long game, trusted the process, and allowed compounding to turn consistency into real wealth.